let's all jump into it. We have, I think, good number of folks inside. Have a few perhaps on the live stream. So let's begin, everybody. Here, a couple ground rules to cover. We only need about 20 minutes to get through all of the material. So let's focus in for 20 minutes, get all the good stuff from this presentation. Send your questions to the chat. And at any time that you have questions, jump to mind. And that way we will address all of it at the end during the Q&A period. And that's how we're going to make this very productive of a meeting. Okay, so everybody's here. Hopefully, you're at the right place. We're talking about building wealth through oil and gas. Okay, and we're going to go over these, we'll say high-level topics, but at the end of this presentation, you're going to understand exactly how you build wealth using oil and gas. Okay, so we're talking about wealth. First, we need to define it. There are a lot of vague, high-level terms that's being thrown around, and it's context dependent. Here, we're going to define it very specifically using numbers. And of course, we're going to show how oil and gas contributes to that wealth. We'll go over foundational knowledge that every oil and gas investor needs to know. And lastly, we're going to make this a very tangible presentation. We're going to use a real example from with real numbers from a past project of ours. Okay, let's dive in. Defining wealth. What do we mean by wealth? Well, it's all about income streams. More specifically, it's about having multiple income streams that are not dependent on your time and energy as input. So let's define and measure that. Everybody's making good active income here. But that actually doesn't count because it's dependent on your time and energy every single day. You have to wake up and show up. So here, from one of my mentors, I learned it as the wealth ratio, and it's a very simple equation. You're going to take your passive income in the numerator and then divide it by your lifestyle expenses. That's it. You can look at this at the monthly level or at the yearly level. I tend to like the monthly level because it gives you a good balance of granularity. So with this ratio, what does that actually mean? What are you tracking? Well, when you get to 1, you've essentially covered your lifestyle with all your passive income. And I typically see that as financial independence, where at this point, your career, your job, that is optional. You can continue to work in it, but you don't have the necessity to. When you reach about 5, I see that as financial freedom. You can start to design your life in the way that you want. And when you get to 10 or above, I see that as having practical wealth. You can start thinking about legacy, having various structures, and all of that starts to make sense at that point. So the wealth ratio is this very useful metric that you can use to measure how far along the wealth track you are. And this is exactly what we're going to use as a metric to achieve financial independence first with oil and gas. Okay? Now, how does oil and gas tie into this? Well, most directly, it's going to be monthly cash flow. And it's about adding to your passive income, the numerator. Okay? And later in this presentation, we'll work out exactly how it works in oil and gas. Second part is going to be capital growth, which is when you invest in something like an oil and gas well, when there is a sale or disposition or divestiture, you're going to get multiples of your initial principal back, 2x, 3x of your principal, of which you can create double the income stream with. We're also going to cover the tax deductions part. And this is something that is very unique to oil and gas that many, many people do not know about. Right? By the end of this presentation, everybody here is going to know not more than 90%, I would say, than the folks that are investing in oil and gas or investing in general. Right? So we'll cover that in detail, how it works. Lastly, we're going to cover the portfolio hedge part, which is protecting your income. And you can already sort of intuitively guess how this helps with your overall portfolio stability. But we'll dive into that as well. Okay. Let's jump in. The most direct piece, right? That monthly cash flow. What are we talking about? It's analogous to real estate in the sense that you have tenants that pay you rent every single month. Here, your tenants that we manage for you are oil and gas wells that produce oil and gas. And with the proceeds, you get checks every single month. So very simple business, right? The wells that you own, and here we're talking about direct well ownership, not oil stocks or any other derivatives. You're going to own a tangible oil and gas well that produces every single month 24/7. Our downstream, which is the buyers of our oil and gas, they're going to send trucks and we're going to offshoot it through our pipelines to sell the product. And then they're going to send us the check, of which we forward all the checks pro rata to all of the investors in our group. And that's how it works. Very simple. We'll have concrete examples of this. But this is how oil and gas contributes to your monthly cash flow. Capital growth, very, very similar play. Where in real estate, you buy a rental property, you rent it out for a couple of years, and you sell it. And perhaps you double or triple your initial capital investment. And you redeploy it again. Same thing here. We're developing a lease in oil and gas with multiple wells on it. We're going to maximize that asset value by drilling new wells, by proving new zones, adding PUDs, and all this perhaps jargon stuff, but just know that we are maximizing the development to maximize the asset value, and we're going to sell it to a mid or major producer when the time comes. Okay, and then you just redeploy the capital back into the same type of setup, and you just snowball this thing for 5 to 10 years. And that's how you get capital growth and additional income streams along the way. This tax deduction piece, we're going to include this in our concrete example. But for now, here's a very simple example of how tax deductions work. And this applies to most asset classes. But what's unique about oil and gas is that it includes your active income. So here's how it works. Check out your tax rate. You can ask your CPA or look at last year's return. Look at how much taxes you've paid in the top tax bracket. And let's say it's an example investment of 300K. Well, in year one that you invest in a project, you get to offset or deduct against your active income by the same amount. So 100% of your investment is deductible. So next year when you file for taxes, the IRS is going to pay you 35% or $105,000 back. And if you have CPAs that don't know about oil and gas, I've put the tax code on the bottom right so that you can refer them to your CPAs. Okay. Now, portfolio hedging, this is once you make a ton of money, you need to protect it. And there's all kinds of risks that you don't get to predict ahead of time. So with portfolio hedging, as everybody knows, we have 2 wars happening right now. We have economic storms, inflation, and all this crazy things that can happen over long periods of time. And we have market crashes, right? Periodic crashes, downturns that really take down your equity, your public equity, like stocks. They just take a tank and then recover. So oil and gas, what's unique about it is this very in-demand commodity that powers the economy, right? If we look at any economy, if you don't have energy, you don't have an economy. So you have a portion of your portfolio in things like oil and gas, it's just that when these turmoils happen, oil prices spike, and that spike is going to help compensate for whatever else happens in the rest of your portfolio. So that's how you start hedging your portfolio using oil and gas. Now, let's talk about the basic investment mechanics. What are you actually investing in? What are you buying in oil and gas? Okay, so this is the foundational knowledge. When we talk about direct well ownership, what you're buying is something called a working interest on a lease. A lease is simply a collection of oil and gas wells on a real property. So this is a tangible asset, much like real estate. And every working interest is a percentage of ownership of all the wells and production that comes out of that lease. Production is measured by BOPD, or barrels of oil per day. So when you own working interest, that's measured by BOPD across the entire lease. We'll have a concrete example at the end as well. Additionally, everybody here should know that every lease comes with a revenue interest. And we have that to secure exclusivity. So a very common example is 75-25 breakdown. How it works in oil and gas is if we are the operators on a lease, we pay 25% to the land and mineral owners for the exclusive right to operate that lease. So nobody else can come in and drill on that lease or operate beside us. That's how it works in oil and gas. And of course, after all said and done, you get a check. All the investors get a check pro rata to your working interest every single month. So, real example. Let's get into the meat of it. Okay. We're going to take a modern family example and we're going to give this family financial independence and we'll work out the math. This is a setup to make it extremely real. Let's say they have a joint family pre-tax income of $360,000. And I'm counting salaries, RSUs, everything that gets reported on your gross income at the top of your tax statement or your W-2s and all the tax forms. I'm also going to assume that they are in a no income tax state like Washington State. If you're in a heavily taxed state, you definitely need to look at oil and gas. Now, same example, I'm assuming we're looking at the cash value. They're going to sell all their RSUs and get everything in cash, stocks, any other kinds of compensation. So using the various calculators that I have access to, they're netting about $23,000 a month in paycheck. And let's say they need $10K a month to cover their mortgage, their rent, car payments, food, and all their living expenses. They need about $10K for their family. And I will also assume that they have negligible passive income. So stock dividends don't really count for anything. So they're starting with a wealth ratio of 0, like everybody starts with. And the last bit of technicality, in this example, they are qualified accredited investors. Right? There's various categories of what makes an accredited investor, but if you qualify, that is what allows you to invest in private deals, exclusive deals like what we do and what many other deal sponsors will do, as it's called. Okay, now let's apply a real project in the past so that everybody gets a sense of what kind of numbers you can expect with oil and gas and how the math works to allow this family to achieve financial independence. Real numbers. This is a past project. We have many projects just like this. So this is not like a unique special project at all in any sense. So let's say it's a 32 well drilling project in the Anadarko Basin, which is where we operate. Very prolific basin. The offering is $100,000 per 1% working interest. And the net revenue interest is 75%. The most common type of percentage breakdown I have seen. I hardly see other types of breakdowns. So every well that we drill, we are going to assume that each well that comes online produces 15 BOPD on average for the first 2 years. This means new wells that we drill, they produce 15 barrels of oil per day on average across the first 2 years. And this is a very conservative number that I'm using because some wells come online for 30 BOPD, 40 BOPD, but let's assume that they just average 15 BOPD for every single well. So across our lease then, once we finish drilling, we have 480 barrels of oil per day across the entire lease. 1% working interest is 4.8 BOPD. And then if we net that against the 75% net revenue interest, what you're buying for 100K is 3.6 barrels of oil per day. That's production. Again, that's what you're buying with 100,000, you're buying 3.6 barrels of oil per day. This is where the oil price matters, right? If it's $85 oil, and I'm using a 30% expense ratio, which is healthy on the conservative side. This means that $85 oil, your check that you're going to receive every single month is $4,800 every single month. So let's put it all together and see exactly what this family needs to do to achieve financial independence. Same family, same project, $85 oil. 1% is 4,800. Remember that from our past slide. Okay, when drilling completes. Drilling usually is 12 to 18 months, depending on the type of well or lease. For this example project, we finished it in 12 months. So this family needs 10K in income to sustain their lifestyle. How does the math work? 10K divided by 4,800. They need 2.08% working interest to achieve that financial independence mark, or a wealth ratio of 1. And there we go. If we back math it, they need $208,000 invested in this example drilling project. And of course, like I said, you always want to stress test the numbers. Oil is cyclical. There are times where price goes down. This is what happens if oil goes, takes a dip to 65. So same math, they need 2.73 working interest to cover their lifestyle expenses every single month. And that initial capital simply works out to $273,000. This is only looking at their cash flow. So next, let's see a concrete example of how taxes work. And if they redeploy the capital, how does that affect their taxes and future income streams? Okay. This is the very special piece about oil and gas. 100% deductions in year one. Again, same assumption, no state tax, and they redeploy their capital. Here, I'm assuming the family is in the 35% tax bracket, just like before. Again, using various calculators, they are paying 35% on 87,000 in income, and they're paying 32% on 54,000 of income. And I believe I used Washington State calculators for this. So when they file for taxes for this family, they invest 100K, let's say today, for example. Next year, when they file for taxes, they are getting a check back for 34,000, more or less, from the IRS. And again, we're also not factoring the other deductions that they get in subsequent years, which is perhaps icing on the cake. But here, we're just saying they de-risk their investment by 34% when they invest. When the assets get sold, and in our example, let's say they get 2x their money back, so they get 200K back when the lease gets sold, they can essentially invest another 100K to offset all of the capital gains in that deal. Or they can reinvest all of it, 200K, and double their income stream and double the tax deductions for next year. So when people claim I pay 0% taxes legally, this is one of the ways that people use oil and gas to get out of any kind of taxation. You invest just enough to deduct a meaningful amount of taxes. Okay, so again, these are example numbers using, I believe, Washington State tax calculators. You definitely want to talk to your CPA or look at your past tax filing and work out these numbers. You can essentially follow my example and do your own numbers, right? Start with your own wealth ratio and then figure out your BOPD and make this extremely tangible for your family. All right, so wrapping it up, oil and gas. This is what industry insiders like myself and my team uses oil and gas for, right? Monthly cash flow. So you build your wealth ratio to 1, 3, 5, 10, and just keep building until you have generational wealth. We use it for tax optimization. So all your active income that you make, I'd rather use my deductions to keep more of my tax money and fund other assets. You can even think of it as maybe getting the IRS to fund your investments, a portion of it. There's even an interesting scenarios that we've set up where we've helped our investors achieve 200% tax deductions. So if the math works and the right deal comes along, sometimes you can get the IRS to fund your entire investment. Okay, so again, that is a more advanced strategy that if people are interested, you can reach out to me and we'll see if your specific scenario applies. Now, the last piece is portfolio hedging. So making the passive income is great, but we also want to protect the portfolio. So if wars happen, like unfortunately they are happening now, then that means if oil spikes, then this part of our portfolio is going to do really, really well against all the other things that may not be doing well. And that's it. This is our team. So far, we've managed already 500,000 acres in drilling land. We did IPOs in the oil and gas space, sales, divestitures to majors. We just really want to invite you guys to learn a little bit more about oil and gas. And come, even if you haven't seen an oil well before, come on site and check out some of our oil wells pumping. Although after about 10 minutes, I think you've seen every single oil well that exists. The technology is not hard. Now, that was a very high level of using oil and gas for wealth creation and how oil and gas applies and how you use it. Obviously, this is not investment advice. I have to keep my attorneys happy by saying, seek a qualified financial professional if you would like. And if you do have a qualified financial professional that you trust, definitely talk to them about this. Most of the time, your financial advisors have not heard a strategy like this before. This is something that oil and gas, we'll say professional insiders, use. Again, contact information for me is below. So with that, let's go into Q&A. Lane, I believe you're still here. So what questions did we get through our chat? Okay, so first question here.
Hey, Mike. Yeah, I have a question.
Sure. Go ahead, Leon.
So you had a practical example and you invested, I think, $100,000. You made a bunch of cash flow. So the oil runs out. What happens to your $100,000 investment?
Gotcha. So let's go briefly into geology a little bit. With oil and gas wells, you have a decline rate. And during our initial investment, you should always be presented with a decline rate, leaning towards the conservative side. There's obviously different types of wells, different formations, different geologies. Typically, we're looking at 15 to, well, if you're doing shale, you're looking at 80% just like declines. So for our wells that we're drilling, usually about 16 to 18% decline year over year. So when I chose an example number of like 15 BOPD, that's accounting for the decline rate over 2 years. So we're assuming here every single well is going to do at least 15 BOPD on average across the lease.
So, but is the 100,000 basically goes to zero, like the initial investment? The land is worthless.
Well, if that's your strategy to maximize the oil production and just hold it until it dries up, then yes, you would essentially wait until you get all the oil out and your 100,000 would go to zero. But at that point, if the economics work out, then you should have made multiples of your money. Some of our wells are over 100 years old. So we can wait 100 years, that well is going to go dry and you'll get multiples of our money back. And with oil wells, they don't usually run dry. Common to like popular belief is it's like a pool of oil underneath, and once you drain it, it's gone. It's not like that. It's more like a sponge. If you start pulling oil out, you have other hydrocarbons that's going to go in and fill. You have a negative vacuum pressure. So that's why you can have wells that produce over 100 years, but at a lower production rate. And there are techniques you can go in and refrac and restimulate to bring on, new production that then slowly declines again. So you're trying to maximize the value. For us, we want to develop a lease to a point where it has maximum value for a takeover, and then we sell it. And then we move on to another lease and do the same thing. So we want 2-3x our principal back in 5 to 7 years.
Cool. Thank you.
Yeah, anytime. Hopefully that answered the question. And let's look at some of the other ones. Practical example. So Ivy, how realistic that you can get 2x when selling the asset? Well, this is where timing matters slightly. In real estate, your valuation is gauged by your peers, how the houses sell in your region. In oil and gas world, how you value a lease is how many barrels we're producing, and majors will typically look at how many flowing barrels, and they'll pay per flowing barrel. So when oil is in a downturn, let's say, a takeover could be, we're going to value your land at 35,000 per producing barrel. So you just count how many barrels you have times 35K. When oil is doing well, like they are right now, your valuation could be 75,000 to 100,000 per flowing barrel. Because when we develop the land, there's the initial value that the buyer is going to get with the oil that they get. There's also what we call more zones behind pipe. There's other geological zones that we can produce, and there are other well sites that the new buyer, that the new owner can then drill and increase their production. So we leave enough upside for the buyer. And we've proven enough of the value of the land out such that they are interested in buying. So how realistic is the 2x? Well, our projections are we develop it to enough where there's enough BOPD that no matter, as long as oil doesn't go crazy down like a huge dip, then we should be able to achieve 2x very easily. And that is part of our financial modeling that is shared during due diligence, right? So as part of every project, we have a financial model that takes an account of what the oil price is, and then how much we're going to drill, and how much each flowing barrel is going to be worth. So that's how we project 2 to 3x when we sell in 5 to 7 years. Okay, so this is financial modeling. From Dave, will you be sharing the slides or transcript? Yes, I will try to get the recording out. If you've registered through Zoom, then that means we have your email, and we'll send you a copy of the recording with the slides as well. You know some CPAs who is familiar with this strategy. So most oil and gas CPAs are going to be very familiar with this strategy. This tax law, the IRS code 263C and 168K, those deal with oil and gas deductions. Those have been around 1986 or 85. Don't quote me on this, but that's how long roughly they've been around. So this is a common strategy that if a CPA is familiar with oil and gas, they should know how to do it. And if they don't, there's the IRS tax codes that they can look up and reference. Okay. I think that's the end of the questions I see in chat. Lane, do we have other questions that maybe came to you directly? Okay, so you sent them to me. Is it always 100K per 1% working interest? No, it can fluctuate. But for clean numbers, we tend to stick with 100K and 1% as just easier to measure. Now, sometimes I will tell everybody here that depending on the project, you won't necessarily get 1% for 100K. If it's a bigger project, that'll actually change. You may be buying 0.5% or something like that. How are oil leases sold to other companies? Okay, I think I did explain that already. Who's responsible for the expenses during operation? So when we send out checks to guys, like all the investors, that's already netted against all the production taxes, expenses, etc. And so when I use a 30% expense ratio, that's what I mean. Like 30% of that revenue check goes towards expenses, production taxes, electricity, parts, all this stuff. Okay. Liability for investors if something goes wrong, like oil spills or environmental disaster. How we do it, and this is by far the most common way, is you have a operating entity that takes on all the liability and risk for any drilling project. So as investors, when you guys are coming in, any oil spill that happens on the lease, that's a liability of the operating entity. It would not flow back to any of the investors. And that's why we have two separate entities. So your checks may come from our operating entity. The one that you guys are investing with, Crown Forge Energy, that's the financial side, the ownership side, which has no liability against operational risks. Okay. What's the timeline? So timeline from investing to the first check. So typically we're looking at a couple of months. So let's say you invest in, day 1 of September 1st. Your first check would come sometime in November, right? September, October, November. Why that is the case is because we have to get all the checks from our downstream, and they're going to pay us based on the rolling 30-day average of WTI oil pricing. So it takes a bit of time to figure it out, and it takes a bit of time to enter it into the system and then distribute the checks to everybody. So that's the delay. But all the oil and gas that's produced is all attributed to your investors. So when you get paid, let's say in November, you're getting paid for all the oil and gas sold in September. So that's how it works. Okay, I think I covered everything. Oh, there's one that talks about if you're in a high tax state, how does this affect my state taxes? It is a bit dependent on your state, but all the investment is going to go offset against your total taxable income. And it's just a matter of how much a state will allow you to deduct. And you have to look at specifically for your state. Okay. So I've covered all the questions that I see. Now, if there are other ones, yeah, no problem. If you got to drop, I totally understand. But that's about it. If you guys have additional questions, everybody can, reach out to me. The email I've shared on the slide, which I'll send recordings to. But if people are wondering, I'll just drop my direct email in the chat. So just mike@crownforge.energy. And that'll reach me directly. So I appreciate everybody joining today. Hopefully this was a valuable takeaway and gives you guys a high-level understanding of how oil and gas works, what it's good for, and how to use it. Okay. See you, everybody.